Welcome to vTalkInsight, Market Drivers Daily for May 20th, 2026. AI remains the dominant equity story, but today it collides with geopolitics and crucial earnings risk. With Nvidia about to report and Gulf tensions keeping oil and yields elevated, cross-asset correlations are tightening. Let's begin with how the AI narrative itself is evolving beneath the headline excitement. The AI theme is still the primary growth offset in an environment of high energy prices and multi-decade yields. But the story is changing shape. Messaging from major technology firms has shifted away from fears of mass job losses toward a focus on empowering workers and lifting productivity. Evidence on the ground supports that nuance. AI adoption is causing significant churn in the labor market, yet there is little sign of a net employment decline, and hiring in information-related sectors remains robust. Instead of wholesale replacement, demand is gradually tilting toward higher-level skills, such as critical thinking and insight generation, while more routine tasks are automated away. Some executives now argue that, over time, productivity gains could even create labor shortages, as higher output allows some dual-income households to shift back to a single-earner model. For portfolios, that suggests greater dispersion within labor-exposed sectors, where firms able to retrain or attract higher-value talent may see a very different earnings and wage trajectory than those stuck in legacy roles. On the macro side, AI-related capital expenditure already added around 0.8 percentage points to recent U.S. GDP growth, mainly via software and equipment investment, and a similar boost is expected this year. Major banks and cloud providers plan to lift AI capex through 2027, even though many do not yet see immediate bottom-line benefits. At the same time, the cost per unit of compute is falling rapidly. Inference costs have dropped on the order of 1,000-fold year-on-year, and AI token costs are declining by roughly 70% annually, making it easier for more sectors to adopt the technology. The inflation impact is two-sided. Near-term, demand for high-value chips is strong enough that it may add about 0.3 percentage points to core personal consumption expenditures inflation, with headline measures expected to peak near 4% and core around 3% for a time. Further out, persistent productivity gains and AI-enabled efficiency in areas like permitting, logistics, and services could become disinflationary, making many goods and essential services cheaper if adoption is not held back by premature regulation. Under the surface, the risk balance has moved from demand to supply. Accelerator demand is growing at a pace nearly 7 times faster than capacity expansion, and Nvidia has locked in around 75% of key components through 2027 as purchase commitments surge from $50 to $90 billion in a single quarter. Market leadership has narrowed as a result. Global equity gains are increasingly concentrated in a small group of AI and semiconductor names, and a potential strike at Samsung, a critical memory supplier, illustrates how a single labor dispute could spill over into Korean equities and AI-heavy portfolios worldwide. That concentration, alongside very high expectations for AI winners, sets the stage for the earnings test we are about to discuss. Geopolitics continue to harden into a structural energy shock, and that backdrop is increasingly important for how AI and earnings are priced. The Strait of Hormuz remains severely constrained, with shipping flows still far below pre-crisis levels and only a fraction of the usual daily vessel count passing through. NATO is debating a role in securing transit, but internal divisions and the complexity of out-of-area operations mean any coordinated mission is uncertain, prolonging disruptions and sustaining a geopolitical risk premium in energy markets. Tensions between the United States and Iran remain elevated, with threats of renewed strikes and warnings from Tehran that retaliation could extend beyond the Middle East. The U.S. faces munitions constraints, while political support for large-scale action is eroding as war powers resolutions gain traction in Congress. Against this backdrop, oil inventories and strategic reserves are being drawn down. A recent 10 million barrel release from the U.S. Strategic Petroleum Reserve highlights how policymakers are leaning on stockpiles. Yet questions are mounting about how long that can continue if the strait stays disrupted. Physical markets are tightening even as near-term price volatility has eased. Analysts flagged June as critical for supplies, with December Brent and WTI futures sitting near record highs and some projections pointing to Brent around $100 by year-end. Higher energy costs are already filtering through the real economy. European business surveys and smaller open Asian economies show growing strain, while forecasts for U.S. gasoline reaching around $6 per gallon this summer underscore the risk of a renewed squeeze on consumer spending and margins in energy-sensitive sectors. At the strategic level, energy trade is being rewired. Russia and China are advancing the power of Siberia 2 pipeline, and both countries are seeking to reduce reliance on traditional partners. The UAE is racing to complete a Hormuz bypass pipeline by 2027, while China pushes to control choke points in electric vehicles, pharmaceuticals, and material supply chains. Europe, for its part, faces rising political uncertainty and must navigate a more transactional world as it accelerates renewables and reconsiders nuclear energy to cut external dependence. A suspension clause in the new EU-US trade deal, allowing Europe to halt the agreement if tariffs re-emerge, adds another layer of uncertainty to global trade flows. These geopolitical dynamics are feeding directly into monetary and fiscal decisions. Markets are now pricing multiple rate hikes in some jurisdictions this year, reflecting concerns that oil shocks and elevated headline inflation could persist, even as central banks, including the Federal Reserve, signal a near-term pause while they wait for clearer disinflation signals. Long-dated government yields across the U.S., Europe, the U.K., and Japan are at multi-decade highs, pressuring valuations but also drawing in buyers who see a new equilibrium. Europe continues to attract some safe haven inflows from Asia thanks to lower direct hydrocarbon dependence. Yet renewed uncertainty could tilt relative performance back toward U.S. large-cap growth. This is the macro stage on which the next earnings catalysts, especially in AI, will now play out. Earnings have become the arena where the AI boom, energy shock, and higher yields converge, and Nvidia sits squarely at the center of that story. Markets have been focused on this print for days, with equity futures rebounding and bond yields easing as anticipation builds. Expectations are extraordinarily high. Consensus looks for sales growth of more than 80% year-on-year and similarly strong earnings per share expansion, driven by surging demand for data center accelerators. Options markets reflect that excitement and risk. Traders are paying a notable premium for calls over puts, with implied moves of around 5.5% in either direction, underscoring the potential for a large post-earnings swing in market capitalization. Many analysts are not just looking for a beat, but also for raised guidance and a convincing roadmap for platforms like Blackwell and Rubin that together could support revenue targets approaching $1 trillion by 2027. Valuation signals are mixed. Nvidia's forward earnings multiple has already compressed from roughly 43 times in 2023 to about 27 times, leaving it at a discount to some high-growth peers, even as data center revenue climbs from about $4 billion to more than $70 billion over 3 years. At the same time, growth rates are expected to slow as the company scales, and rallies across global indices have become heavily concentrated in Nvidia and a small cluster of AI and semiconductor names. That concentration, combined with tight supply chains and Nvidia's heavy purchase commitments out to 2027, makes today's guidance and supply commentary critical for sentiment. Beneath the headline, earnings breadth looks better than the index narrative suggests. Several U.S. portfolio companies outside the dominant tech narrative are delivering around 16% annual earnings growth, and recent results from retailers, such as Target and Lowe's, surprise to the upside, indicating that consumer demand has not collapsed. Defensive names like Walmart are expected to show steady progress, while companies such as Hasbro highlight how diversified cash flows, including recurring licensing income from digital franchises, can help absorb higher input costs linked to $100 oil. However, parts of consumer discretionary are already seeing downgrades as fuel and energy costs erode margins. The key near-term question is how far current prices already embed the AI earnings story. A strong beat and higher guidance from Nvidia could reinforce the case that AI-related capex and demand remain in an early phase, potentially reigniting risk appetite for semiconductors and adjacent infrastructure plays. Yet with much of the good news arguably pulled forward in options pricing in a sizable move, There's also scope for a so-called good news, but sell the fact reaction if results merely meet lofty expectations. In that scenario, attention may shift back toward earnings breadth, valuation support in less crowded sectors, and how companies across retail, industrials, and services are coping with higher energy and funding costs. Pulling this together, AI remains the key structural growth driver, but it now sits alongside persistent geopolitical energy risks and a finely balanced earnings season. Productivity gains, supply bottlenecks, and evolving labor dynamics are reshaping inflation paths and sector leadership, while Middle East tensions and higher long-term yields keep policy and valuation questions front and center. Nvidia's results will help clarify how much of the AI boom is already in the price and where earnings power is concentrating. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.